Welcome, I'm your host, Conrad Chua. Before we get started, if you're new to the show, you can put questions in the comments field, whether you're watching us on LinkedIn, YouTube, or Facebook. And you can start by writing down where in the world you're watching this from today. And if you're a returning viewer, you'll notice the new branding. So we did a very scientific survey on LinkedIn, and we've now chosen to rebrand this to the balance sheet. The show started with a very strong careers focus. We'll continue to have some careers content, but you, the audience, have shown that you want to rise above the noise of everyday news and learn about the most important business issues of today. So we're now at the balance sheet. On to today's show. We've seen over the last few years, countries all over the world try to encourage more competition in different parts of banking, whether that's commercial banking or retail. And they put in place regulatory frameworks to allow these challenger banks to emerge and challenge incumbents. So today we'll look at how has that gone. Our first guest is Tim Harvey-Samuel, who is the bursar of Trinity Hall College here in Cambridge, otherwise known as the CFO of the whole place. He's a 20-year veteran of capital markets, and he's also he works very closely with a business bank here in the UK. So thank you very much, Tim, for joining us.
Thank you, Conrad. Pleasure to be here.
We also have Dickson Ma, who was an MBA student here many years ago, and he's now the Chief Marketing Officer of Lenovo PCCW Solutions in Hong Kong. Before that, he worked in business development for Alipay, Hong Kong, and Livi Bank, another virtual bank there. So welcome, Dickson.
Thank you for having me.
Yeah. So why don't we get started with you, Tim, in giving us a context into why, at least in the UK, the government wanted challenger banks.
Sure. Thanks, Conrad. So the roots of this really go back to two things. First, like so much, is the global financial crisis. And the second is the regulatory, the Basel regulatory framework. And one of the conclusions coming out of the financial crisis, which did affect the UK banking system, particularly badly, was the need to stimulate and diversify the provision of credit to small businesses. The UK is historically quite a consolidated banking environment. And so the Bank of England very specifically designed regulation, to limit, frankly, the dominance of the clearing banks, and B, to stimulate competition. And the limiting took the form of those banks that have received government support were mandated to carve out certain parts of their network as, if you like, sort of embryonic challenger banks. And they made it easier to build a new business and to enter that specific business. The Basel III aspect really relates to the weightings that small business lending received, and that's a 10-year plus discussion. That is still a very dynamic area of debate today. But the way that it worked was really such that for very large banks in the UK, residential mortgages were great business. Retail current accounts were pretty good business. Corporate lending was great business, and investment banking, and underwriting, if you got it right, was great business. But small business lending was less attractive for them than those other business areas because of the capital weightings that it received. And so they wanted to stimulate the provision of small businesses. So a number of firms took them up on this challenge and set up a bank. And at Trinity Hall, which is where I am today, the bursar, my predecessor, who was also an ex-banker, sensed an opportunity, talked about it with the pension fund of the local authority here, Cambridge County Council Pension Fund, and together they seeded a bank, bought a license, put together a business plan, put together a management team, and obtain, after passing the regulatory clearances, obviously, which were pretty arduous, obtained a license from the Bank of England. And so the bank was born in June 2012.
That is absolutely fascinating. I know Cambridge has given birth to many great revolutionary ideas, but I never knew it gave birth to a bank.
Yeah. Well, there you go. And actually, this was intended not to be a revolutionary idea. This was actually intended to be a return to the way that small business banking used to take place in the UK. So it's a very interesting point, Conrad, in that it was the edge, and I think we'll go on to talk about this later. The edge was really the granularity and the specificity of credit judgments. And it was felt that a more nimble operator could have an edge there at a time where big banks were doing that increasingly by computer for small business lending and moving further away from the customer. So we felt if we could be closer to the customer and with more granularity of credit judgments, that might give us an edge. So it was back to the traditional sense of small business lending.
Yeah. So we'll come back to you, Tim, to find out how do you start a bank from a blank piece of paper. But Dickson, what was the experience in Hong Kong? Were there a lot of interest into, coming into a new sector, perhaps?
I think for fintechs in Hong Kong, I think since the middle of 2000, maybe 2015, there was an uptick and a lot of interest in fintechs in Hong Kong. And the regimes and the regulatory at that time were encouraging a lot of investments, with Alipay being one of them. I was fortunate enough to be part of the founding team of Alipay Hong Kong, and it was backed by Ant Financials in China and also CK Hutchison, the conglomerates based in Hong Kong. So we started in 2018 with the vision of creating an e-payment lifestyle super app, which utilizes QR code payments that covers basically everything from your online to offline payments, your transportation payments, bill payments, and even wealth management solutions.
So what was was it because technology had evolved to the point where now all these transactions were possible with either your smartphone or a card that really gave rise to this market opportunity?
I think, to be honest, interestingly enough, Hong Kong was actually one of the leading market for contactless payment back in the 2000s. And Hong Kong has an Octopus card, which is the predecessors of Oyster card in England. And instead of just applying it on mobility and transportation usage, Hong Kong actually expanded it towards, a convenience store in the very beginning. To you may use the Octopus card to enter premises. They can check your identification with the NFC card. So that was the beginning of, I would say, fintech, or even the game changer of the payment landscape in Hong Kong. And I think since then, there was quite a number of initiatives trying to replicate or even compete with the Octopus, with Alipay being one of them.
Yeah, and I guess one of the big advantages of Alipay is that it's mobile first, right? It was born from a mobile environment, whereas the Octopus card was physical, and trying to use that online would have been a very difficult thing to do.
Absolutely.
Yeah. So we'll come back to you, Tim, later, right after we see where some of our viewers are from. So just a shout out, we've got Arifat in London. Someone's viewing from Qatar. Ella's in Beijing. Dusan's in Belgrade. Mohammed is here in the UK in Canterbury. Gianni is in Zurich in the office of a major bank. Alicia's here in London. Neil, New York. Maria from Sao Paulo. Sahil in Mumbai, someone else, Tanmay from India, Aaron, who's been watching this every week in Surrey, so thank you very much. And just a reminder that if you've got any questions, please put them in the chat or comments. So Tim, if I come back to you, you had the chance, or your predecessor had the chance to create a bank from scratch. And why is it that your predecessors thought the edge was going to come from that human interaction versus very rigorous, data-rigorous, algorithmic approach?
I think it really comes back to the customer type and the customer service. I think if we were very explicit about being focused on small business lending, from the start. Mostly these are family-owned businesses with a reasonable size range. But our sense was that these are people who are going to value, who build their businesses through successfully developing personal relationships. Why should the provision of banking services to them be necessarily less personal than the way in which they've built their business? And if you look at, so there are some quite interesting models in the Scandinavian countries around this. Svenska Handelsbanken is a very interesting bank where they have a very autonomous sort of branch manager type system, and the branch manager really owns the responsibility for the activities of his branch, and that's been a highly successful system. And you saw, very interestingly, shortly after the crisis, you actually saw Svenska Handelsbanken expanding in market towns around Britain with economies, with prosperous local business activity of the type where Cambridge and counties would also now operate. So that judgment that there was an edge in personal banking supported by modern technology, but where the customer contact was not technology driven, it was human driven. That was a good judgment, and I would say history the succeeding decade has vindicated that judgment. And I think, but obviously at the time, you don't know that you're right. We were lucky; we had very strong partners. The college governing body was very supportive, given that this is quite an unusual investment for a Cambridge college to make. And so, as with every new venture, there were a host of uncertainties, but the basic plan, the basic intuition that the customer base wanted a service that they weren't getting from the large banks which were in rehab after the crisis, that was correct.
And Dickson, for your experience, you do more like retail, banking, so it's mostly individuals. Did you see that? What was the market need that these individuals had? Was it just faster credit approvals, easier ways to shop online? What was that in Hong Kong?
Thanks. I think from the top end of the value chain, everyone is looking for a product that is easier to sign up. So the KYC, period must be seamless and very fast track approval. And for the customer need, I think it's mainly driven by consumer incentives. Unfortunately, in Hong Kong, I think the incumbent markets was dominated by a lot of players. So from credit cards to even NFC payments. So to be honest, there wasn't really an unfulfilled need, perhaps compared with a lot of unbanked areas. Hong Kong is one of the places in the world where you have one of the highest credit card penetrations. So people on average has 4 or 5 credit cards. The sort of unmet need, if I may say, was previously before e-payments was perhaps a lack of an interface that really tracks your user payment journey. So for your everyday spending habits, there wasn't much credit analysis. So I think it sort of resonates with what Tim said. If you have some data and you gain some traction, perhaps that's a base for the credit history building for the future. So, I think in Hong Kong, even though we're still starting to build the sort of offline, online credit history, credit database, it's starting to gain some more traction these days.
Okay. So this data of people's spending habits and transaction history was something that, let's say, Alipay or other banks really valued, so that they could give them better data to make lending decisions later on. And I guess on the consumer side, that means they build that credit history. Is that right?
Absolutely.
Okay, yeah. So you mentioned how Hong Kong is such a crowded market, with credit cards, banks, etc. So how have these new fintech companies like Alipay and Livi Bank and others, how have they fared in the last couple of years?
I think since the COVID pandemic and also the crypto crunch, it has not been easy. To be honest, for a lot of fintech players in Hong Kong or in Asia in general, it tries to replicate the model of customer acquisition, and then you try to predict a certain percentage that you can monetize from them, and that's how you get a probably higher valuation back in the days. But so far, since the crypto crunch, valuation has not been easy. So for all these fintech players, those who are still standing, I think everyone is trying to emerge from the competition with a solid commercial model. So now it's not just validating based on the number of users that or potential monetization you might possibly have. So you need to have a very solid commercial model and also play within the rule books and play within the regimes at the same time. So it has not been easy.
Yeah, very important to play within the rules. But Tim, I got this comment from Aaron, who says, who talks about, let's say, micro organizations. So I guess it's microlending, micro banks. Is this something which challenger banks were supposed to go into, and have they?
Not really in the UK, but challenger banks is quite a generic term now. There's a very large spread of challenger banks. So it's become, I suppose, a bit like the term hedge fund, in that it's a sort of generic term which describes rather a wide scope of quite different businesses. I do think that in the first instance, and this dates back to when I was still a banker, but I think in the first instance, post-crisis, the real aim of the Bank of England was to support what it would call small business lending. And that I think, you could frame it as micro organizations, but in reality, it's probably one or two tiers up from that in the size scale. But also, I think there was a strand around retail lending and bringing a bit more competition for current accounts in. And that spawned a number of challenger banks, which are also challenger banks, but which have activities that are quite different from us. I think within that sphere, there is probably a line of business which corresponds more closely to, in inverted commas, micro organizations. In our case at Cambridge and Counties, we're quite a small bank, and balance sheets now are $1 billion, but obviously that's after several years of growth. We were pretty focused in terms of our target market, because I think the risk is having too many target markets if you're a small bank and losing that customer focus. But I think there are challenger banks that in the UK that have supported micro organizations largely as part of their retail activity.
And obviously there are others that are not banks that have tried to get into this lending side of things, right? So people like Funding Circle, peer-to-peer lending. I want to ask you, Tim, what's your take on these these modes of lending that have looked at just one part sliver of a traditional bank, and then I'll ask Dickson whether that's popular in Hong Kong and Asia as well. But first, Tim.
So I certainly think it's had a moment of popularity. I wonder if that moment has passed, candidly. I think that provision of credit in the sort of challenger bank area, as far as we can measure it, has been growing as a proportion of whole for challenger banks. I think after initial period of explosive growth, I'm not sure that the very specific alternative channels that you mentioned have grown so rapidly. Again, quite a lot of activity there that you'd probably classify as more retail in a way, they're not competitors. They're not competitors of ours. They're not competitors of the people with whom we compete. So in the UK specifically, I'd say not so much actually.
And Dickson, in Hong Kong and Asia, is this sort of peer-to-peer lending quite popular?
I think not so much, to be honest. I think peer-to-peer lending in Hong Kong, we still have a very strict sort of regime for lending facilities. So it's now strictly granted to the incumbent banks, also virtual banks and small lenders. But for P2P lending, it is still unregulated and it's not encouraged in Hong Kong and Asia. I think the governments in Asia or China, Hong Kong, they're trying to have a more measured control approach on P2P lending.
Yeah, because at least in the UK, it's something like, I think its funding circle kind of blew up in a way when some of their loans just, the control of non-performing loans sort of blew up. But maybe at this point, we could talk about some of the challenges that challenger banks are facing at the moment. How well have they done? Who have done well out of this? So, Tim, in the UK context, obviously your bank is doing well, but looking at the entire landscape, has the UK's government's experiment with challenger banks worked?
Yeah. Yes. So I think it's worked. I think it's working, and you can see that in a rising proportion of aggregate small business lending, which happens to be what I track, comes from our neck of the woods. So collectively, we're growing as a subsector. And the funny, when that happens and when you're in a business, it's quite amusing sometimes to look at each individual competitor's growth projections, aggregate them, and see if they will usually aggregate to a completely unrealistic assessment of what the growth projections for the entire industry will be. And that sort of tells you that that maybe a few people are being a little bit too optimistic. And I think a few people probably are being too optimistic, particularly in the economic environment we currently face. But the proportion of the whole has been rising. So yes, it's worked. The challenges are, I would say, twofold principally. There's a sort of regulatory stroke economic challenge, which is around how do you earn a decent return on your capital in these businesses. It's a highly, the Bank of England definitely set out to stimulate competition, so it made it quite straightforward, difficult, but not impossible to get a license, and that's as it should be. However, once you've got the license, the regulatory regime is very, very firm around capital ratios, how much capital you need to hold. It's very, very firm around, have you got the credit grading systems to know what's in your book, to stress test what's in your book, and to be able to provide adequately for that. And if you assume that the challenger banking institutions are going to have a somewhat higher cost of funds than a large clearing bank, then the question is, what's a suitable return on equity? What's the return on equity that rewards shareholders appropriately and maybe even attracts new competitors to join the business? And I think 10 years in, with the fast evolving regulatory environment, that's still a question that isn't fully answered. I mean, we're very happy with our bank. We haven't taken a dividend yet from our bank because we like reinvesting the profits and compounding the returns in that way. And that gives the bank the fuel to continue to grow from organically generated capital. So that's working very well for us. So I think that's a sort of regulatory / economic challenge. And then I think there's a customer challenge because, we're not going to have the same marketing budgets as the big banks. We are new name, we're by definition on the whole new names on the block. The customer recognition may not be there. And so what we try to do is differentiate ourselves through service. So that's the human voice, the individual credit judgment, the ability to process and turn around loan requests quickly, and then service through the life of the loan. So being responsive to the customer, and using technology to facilitate that, but not to become the voice of the firm to the customer. So I think there's a regulatory challenge and there's a customer challenge. So far, enough of us seem to have been able to thread that needle to create a thriving subsector, but it will continue to evolve because we've got Basel 3.1 coming down the track. That contains the draft provisions of that contains some quite stiff regulatory aspects around small business lending, and we're going to have to work through that. It doesn't scare us, but that's just a new challenge of the regulatory type that we'll have to go through. So I think those are the two challenges, Conrad.
I thought it was interesting you mentioned it's regulatory, the economic, customer, but you didn't mention any challenge from the incumbents. So is it the case that the bigger banks still don't see this as a viable market for them?
Viable is quite a strong word. I think it's, but I mean, certainly not mentioning it was deliberate. I go back to what I was talking about sort of about 10, 15 minutes ago. The way the regulations work for the big banks creates strong incentives for them, certainly in the UK, but I think this is internationally broadly relevant. Aspects of the retail business around current accounts, residential mortgages, obviously fee earning services, very, very attractive. Big corporate lending and investment banking, if you can manage the risks, very, very attractive. The capital weightings and the regulatory hurdles around small business lending, not so much. So we see them and they sort of dip in and dip out, I'd say a little bit. And they are a clear and present danger all the time. But the competition within the challenger banks and amongst the challenger banks is the principal competitive driver of behavior in our subsector.
And Dickson, you mentioned how crowded the banking sector or financial sector is in Hong Kong. So have the big banks, I'm thinking like HSBC and all, had they taken on new capabilities to compete against Alipay or Livi Bank?
I think the incumbent players have most certainly responded in two different ways. I think when Conrad mentioned HSBC, it's also a good example because HSBC when the virtual banking license were open for application, HSBC deliberately did not apply because they thought it was easy for them to create a digital arm for P2P payments and also for offline payment, and which they did. They created an app called HSBC PayMe, and it just rivals the competencies of Alipay and also other smaller e-payment arms. And I think for a lot of the incumbent banks, which took the other side of the coins, actually, when the virtual banking license were open for application, out of 8 of the successful applicants and now who are operating virtual banks, 5 of them have they are from the major banks. So Standard Chartered, Bank of China's, all the big boys joined the trend and also joined the competition in the virtual bank aspect. And I think just going back to what Tim mentioned earlier, and I think both the challenger banks and the incumbent banks, they face a similar regulatory challenge because in a way, the way the virtual banks are governed in Hong Kong, they face similar AML requirements as the traditional banks. They also need to report and have the same compliance setup. So from the backbone of it, they are on the level playing field. But from an user acquisition sides, the traditional banks already start off with, let's say, out of 7 million people in Hong Kong, they have 3 or 4 million user base already. So the challenger banks need to spend a lot on user acquisition while sort of generating a reasonable returns to satisfy the shareholders, which unfortunately, most of the shareholders are traditional bank shareholders. They wouldn't have the tolerance of seeing the negative return in the first few years. So in that way, I think the challenger banks and the virtual banks, they operate in a very interesting aspect. The line, the room for error, it's actually very thin for them.
I thought it was really interesting when you said that all the incumbent banks thought that it'd be easy to set up something to compete against Alipay because in the business school, we always talk about organizational culture being a real, both a barrier, but also could be a real source of differentiation. And the idea in terms of this, in terms of disruption, has always been that if you're an incumbent, it's not so easy to take on the organizational culture of someone like Alipay that came from the tech, that came from a tech side, for example.
Right.
But I guess, Tim, I wanted to ask your views. Is it, setting aside the regulatory aspects, but thinking back into your experience in capital markets, is it organizationally easy for a well-established financial institution to come up with a digital arm to compete against, let's say, a tech firm?
I mean, no is the short answer. Something tells me that Dickson will have far more expertise on this than I do. I know enough about the industry to know that that is not easy because of the sort of dead hand of legacy systems, if you know what I mean. So I think that's very problematic. However, conversely, within the UK Challenger Bank, it's great that you get to start with a clean slate on technology, and I think some challenger banks, particularly in the retail space, are doing a really nice job on reinventing how the retail customer interfaces with finance and with banking, and you can only do that with a clean slate on technology. What we find in the business area, in the business banking area, is a lot of people still like a human face or a human voice at the end of the phone, and that it's important to have the technology behind that's helping you make good decisions, and it's important to have the technology that eases the customer interface wherever you can. But when you've got we've got, whatever, several hundred customers. We don't have several million customers. And so being able to service those customers appropriately is really, really important. But I think, Dickson, you're going to be far more expert in this than me, I'm sure.
Not at all. Perhaps I can also share some of the observations I had in the fintech area. I think for a lot of the incumbent banks, setting up a digital arm has been a disruptive experience, both internally and externally. Just from the organization setup, now you have 2 different teams doing entirely different things, and it has not been easy. And for a lot of the bankers, I think Tim is one of the rare breed that made a perfect transition to the digital side. But just from my observation experience, when you have all these legacy systems, as Tim correctly points out, and also the traditional banking mindset, it's not exactly easy to turn into a digital person overnight. And sometimes when traditional banks, they try to go digital, they try to place too much importance on the user experience, which it's hugely important in the digital side. But unfortunately, they probably oversee the commercial aspect of it. And also for the internal sort of teams to adapt a digital mindset, it is quite a steep learning curve. So when a lot of the fintechs set up in Hong Kong, they actually try to attract talents from abroad, from China, from Asia, who had probably more relevant experience in the digital side. So you probably need a little bit of both worlds to flare for a traditional bank in setting up digital arm. So it's not easy.
Great. We've got a couple of 2 questions, which I think probably we can condense to one. So Marina talks about how difficult it is to open a bank account sometimes, and how maybe it's these regulations that squash innovation and kills a lot of interesting companies before they can even get off the ground. Leon feels that the major inhibitor of innovation is the Know Your Customer and anti-money laundering regulations. Tim, maybe we start with you. Do you feel that it's a lot of these heavy-handed regulations at play that kill off innovation?
It can be. It can be. I mean, I think that that there is no question that the regulations around customer processing in the UK and the EU have got vastly heavier in recent years, and it's a huge part of our board agenda whenever we meet. But in a way, the regulatory obligations, most of which in this area have been developed on a global, certainly a very international level. One of the defining traits that I've noticed in the last 7 or 8 years is how much more regulators share with each other in terms of common standards, and how they keep raising the bar, particularly in respect of AML and customer onboarding. That probably, I think, I'm not sure it constrains product innovation. It does constrain customer growth, but it is an area where banks in the past have really struggled. And so I don't necessarily, we have to work with the regulatory environment we have to work with in our bank, and we do our best to maintain customer service levels and improve them around that. I can understand customer frustrations around the process. I really can. And at the last board meeting, we have a bit of time out where we go down to the down to the business units for an hour or two and spend some time with the people there. And I happened to spend a bit of time on the desk that is dealing with customer approvals, and the sheer volume of checks that they have to process in order to onboard customers in compliance with the regulations astonished me, actually, and I left full of respect for them for doing the job they do in the way they do it. But those are imposed on us by the regulator, and generally they're international or global. I can understand customer frustration. I really can, and I think this is coming through in the comments.
Yeah.
Whether that kills product innovation, I'm not so convinced. There's a pretty dynamic fintech environment in the UK, and I think that I think there is a risk that you get tech investors investing in things that are actually banks, and there are going to be some quite interesting return implications for that, because the types of return that the regulator will basically allow you to earn on the equity of a banking institution are wildly different, obviously, than successful technology entrepreneurs, on the West Coast or the Nordics or wherever, can generate on their investments. So I think it's always important to remember what you are. Are you a tech company or are you a bank? Because if you're a bank, your marketing and your PR may say that you're a tech company, but that's actually not true. You're a bank.
And I'm a senior treasurer for a student club here in Cambridge, and I can tell you that having to go to the bank every year to verify identity is crazy. We'll take one last question, maybe first Dickson and then Tim. So Dan spends much of his time trying to navigate these regulations for fintech clients, and it's such a complex maze, especially when one looks at it globally. So Dickson, first, do you feel that this is a source of great frustration on fintechs, where they are used to coming from the technologies? Maybe they come from a technology world where they're used to scaling and going across borders so easily, right? And now they've got to be faced with all these different regulations, sometimes local, sometimes regional. Did you get that sense working in Hong Kong?
I think even though the regulators are trying to keep up with the speed and also the scale of fintech developments, most definitely the regime, it's having a hard time of playing catch-up game. So I think the frustration, apart from the regime, actually, I would like to go back to the previous question. It's not just the regulators who are holding back the sort of scalability and the rise, the metric rise of the fintechs. In a way, the users and the consumers are also part of the reason. I'll take Hong Kong as an example. I think the data in Hong Kong are still sitting in very silo islands. So in generally, it takes a lot for users to share his or her own data. And there isn't one common sort of credit history data pool. But whereas in China, for example, in Alipay in China, it has its own credit scoring system. So it's called Sesame Credit, and it measures your behavior. For example, if you rent a bicycle from an area and then you return it in time, you get additional bonus for your credit score. And if you use Alipay for e-commerce purchases and you pay on time and it delivers on time, obviously there's also a plus. So those sort of credit data and also data sharing create meaningful customer profile. And banks in return, or fintechs, can carve out differentiation on the whole user experience, and ultimately, to borrowing Tim's word, you have different credit description for lending. So I think that's also takes a customer mindset change to prompt the sort of fintech development. Obviously, I'm not saying, the China sort of model of data sharing is the best, but in a way, I mean, as consumer and users, it probably takes some time for us to see the true value of sharing the data and what kind of data we are willing to share to our own benefit.
I'll give the final word to you, Tim, in terms of, do you think that, you see fintech companies having a positive influence on regulators in thinking, actually, there are certain things that regulators can allow to give more choice to consumers?
I see technological improvements doing that. I don't necessarily, and I think fintech is obviously an important part of that. As you will have gathered, Conrad, from my previous answer, I'm quite wary about that dividing line between fintech and banks, simply because I see quite a few of our competition, who I absolutely know are banks, positioning themselves as fintechs, and I think sound use of technology to understand our business better and to understand our customers better is absolutely going to be constructive vis-a-vis the regulator. And I think that's true whether you're a bank or a fintech. So, we are big, despite what I've said about being a human face, we are big believers in technology. The use of technology over the decade of our existence has vastly improved our ability to understand our customers and our book, and I think that's got to be a good thing.
That's very prudent words from you, and your 20 years of experience in banking really came through there. So thank you so much, Tim and Dickson, for sharing your experiences and your insights into the world of challenger banks. For our viewers, thank you for joining us. Our next episode is actually in 2 weeks' time, on the 24th of March, at a slightly later time, 2:45. But we'll have 3 people who will talk about minority-owned businesses, specifically what are the challenges that they face in terms of accessing capital, but also what lessons minority-owned businesses can have to, say, challenge the prevailing ideas that we teach in business schools. Is there a better way to do business than the whole Silicon Valley capitalist model? So once again, thank you so much, Tim and Dickson, and I hope that our viewers will see you in 2 weeks' time.
Thank you so much.